So it feels like there's a lot riding, maybe not just on these numbers, but on Tesla execution generally. I mean, the shares have doubled since last April, but they've kind of gone sideways. It kind of tread water since September. So, what, in your view, would sort of move the needle more substantially in terms of these numbers?
Yeah, in our view, it's all about risk reward. And given the run up that the stock had had really since last April, caused us to go to a sell last fall. We just felt like the risk reward was no longer favorable and, in fact, unfavorable. So our current price target is $350. If you look back over the last several quarters, Tesla has not had a very good earnings track record. In fact, they've missed on the bottom line in 7 of the past 9 quarters. So I think what you're seeing with the shares, both today and leading up to this release last week, ahead on Wednesday, is there's really a lot of caution. We know Tesla's earnings were down 31% year over year in the first 3 quarters of last year, and now they're getting ready to report the fourth quarter, the first quarter in which the U.S. EV market was no longer subsidized by federal EV tax credits. So we're expecting a more substantial year-over-year drop in earnings. If you look at consensus, they're expecting earnings to be down 38% year over year. And we think that really this earnings malaise is going to carry over into 2026, which is our primary concern. It's just the disconnect between what the stock price has done over the last several months and the earnings trajectory that we see in the coming quarters.
And in your view, is that elimination of those tax credits sort of twofold? On the one hand, maybe reduced demand for Tesla vehicles. On the other hand, they sold those tax credits, right? And that was a source of revenue for them too. So what sort of combined effect, how should we be looking at that?
Sure. So we know exactly what Tesla's vehicle sales were in the fourth quarter. They reported that in early January, and their sales were down 16% year over year. But our bigger concern with Tesla is just the sale of these regulatory emissions credits under CAFE standards of the U.S. government, and that's been a very fast-growing, high-margin revenue stream for the company in recent years. And essentially, that market largely went away overnight with the signing of the One Big Beautiful Bill Act because CAFE standards were no longer enforced. And so these emissions credits, which Tesla would sell to other automakers, which didn't have as much EV exposure, was a very profitable source of revenue and earnings for the company. And so that largely will go away. And that's going to really affect Tesla's bottom line, in our opinion. So, and then, you look at 2026, and this is a year where Tesla really has a lot to prove from an execution standpoint. They've promised volume production of the Cybercab, the Semi, and the Megapack 3 this year, and so it's a big year from an execution standpoint, and we think the management really has a lot to prove here.
And on that front, what is your outlook for robo taxis? I think Morgan Stanley sees 1,000 of them on the road by the end of this year. Is that reasonable?
Our outlook is it's a very impressive technology, but that the rollout is going to be a lot slower than what management is forecasting to. Already, since they went live in Austin in June of last year, the rollout has been much slower than what they had promised. So we think that will continue. Even last week when they announced that they've gone fully unsupervised in Austin, it turns out that the Tesla vehicles were being followed with other Tesla vehicles, which did have a driver. So that wasn't really true, and we just think the rollout to other markets is going to be a lot slower than expected. Based on our channel checks in other states like Nevada, they're well behind in terms of filing the necessary paperwork, in terms of getting permitting. And so we think it's going to be much slower than what they're expecting, which is a big risk.
So we spent all of our time talking about Tesla, not surprisingly. I got to ask you a question about GM though, too, because it reports tomorrow morning. There you have a hold equivalent rating. And it feels like both Ford and GM have really been struggling to just correct their trajectories right now. So what does GMs need to do? How do they need to deliver?
Well, GM has had a great run. You look back, they've beat on the bottom line for 13 straight quarters. The stock was the best performing auto manufacturer last year. GM shares were up 54%. And compare that to Tesla, which Tesla shares were up only 11% last year. So it's had a great run. This was one of our top picks in 2025, and we just went to a hold on valuation in mid-December. Um, so many things have gone right for GM. They've grown their market share in the US significantly over the last 3 to 4 years. But really, it's their large EV exposure which gives us some pause here, and was really the reason why we head to the sideline. They've become the second largest company seller of EVs in the United States in recent years. And we've seen where they've already taken some write-downs related to their significant EV assets and investments that they've made. And while EVs have been a major growth driver for the company in recent years, we think there's going to be a reversal of that, where they're actually going to lose some market share this year, due to the EV tax credit expiring. So we're a little more cautious, and again, it was a risk reward call. The stock had a big run up, and we just no longer saw a favorable a risk reward that really appears more balanced here in our view.
Garrett, thanks. Appreciate it. Good to see you.
Thanks for having me.